Welcome to the research desk. Imagine holding a navigational compass that flawlessly points toward true north, but the needle vibrates with such violent intensity that it actually shatters its own glass casing.
The compass essentially destroys its own housing just trying to point you in the right direction.
That was the exact reality of the V1 allocation model. It possessed the raw directional truth of the market, yet it was virtually impossible to operate because it constantly tore its own portfolio apart. Today, we are examining the culmination of the allocation equation series, specifically the transition from that volatile V1 regime detector to the highly stabilized V2 allocation system.
This transition represents a fundamental shift in how quantitative models interpret macroeconomic data. We are evaluating a system that successfully cut regime flips from 70 down to 27 over a 108-month period.
Not just the flips, but simultaneously lifting the Sharpe ratio from 0.97 to 1.04 and reducing portfolio turnover by an astonishing 33%.
The core question we have to answer today is this. When a model suddenly behaves better, changing its mind far less often, and capturing smoother returns, has it actually learned the market's underlying structure, or has it simply memorized the specific path of the past?
I approach this data with the perspective that V2 represents a genuine structural innovation. It is an engineering triumph that separates leading, coincident, and confirming signals to capture the true multidimensional nature of market regimes.
I look at the exact same performance summary and see a fundamentally different reality. V2's performance is deeply suspicious because its added complexity and precise parameter tweaks were calibrated on the exact same 108-month sample used for testing, making it a prettier, overfitted illusion.
To understand why I view the V2 architecture as an engineering triumph, we must first look at the fundamental reality of economic cycles. Economies are massive, heavy systems. They do not turn on a dime.
An industrial supply chain does not instantly halt because a single manufacturing index ticked downward by a fraction of a percent.
Exactly. And consumer spending does not evaporate overnight because of a minor fluctuation in bond yields. And yet, many quantitative models are built to react exactly that way, with hair trigger sensitivity. By moving away from a single, highly sensitive indicator, the V2 system effectively diagnoses the economy in 3 distinct dimensions.
But bringing regime flips down from 70 to 27 looks exceptional on a performance summary. It is exactly the kind of metric that sells a model to institutional allocators.
It is not just a sales metric, though. The reduction in flips and the Sharpe ratio lifting to 1.04 is not some mathematical accident achieved by turning optimization dials until the historical numbers look acceptable. It is a necessary, logical, mathematical consequence of structurally separating leading indicators, coincident indicators, and confirming indicators.
The specific mathematical methodology used to achieve that stability requires intense, skeptical scrutiny. We are evaluating a model that achieved this drastic reduction in turnover by calibrating brand new parameters on the exact same 108-month testing sample that is being used to validate its success. V2 solved the primary operational failure of V1, severe operational instability, by fundamentally understanding how economic data layers together over different time horizons. It requires a consensus of economic realities before it commits capital to a new regime. In the discipline of quantitative finance, calibrating on your testing sample is a classic, glaring red flag. Adding mathematical knobs to a model will invariably yield a smoother historical equity curve. It mathematically allows the model to perfectly navigate around the specific drawdowns it already knows are coming.
Before we can properly dissect the complexity of V2 and debate the validity of its parameters, we must establish exactly what it was built to replace. We need to understand why that predecessor ultimately failed, despite being directionally correct.
V1 was an unvarnished, single-indicator regime detector. It relied entirely on the defensive-cyclical spread.
For clarity, this means the model looked at the performance of defensive equities, like utilities and consumer staples, which provide stable dividends regardless of the economic weather. It then compared them against cyclical equities like industrials and consumer discretionary stocks, which thrive only during economic expansions.
V1 used this single spread as a real-time gauge of institutional risk appetite versus capital preservation. It was raw, and it was exceptionally volatile.
But we must ask the critical question here. Did V1 actually fail, or was it just profoundly misunderstood? Let us look at the definitive ultimate test of the 2022 market environment.
That was a year defined by an aggressive global inflation shock and one of the most violent central bank tightening cycles in modern financial history.
In that highly destructive environment, how did this raw model perform? V1 returned a positive 5.7%, while the broader SPY dropped a devastating negative 18.2%. Let that delta hang in the air for a second.
A 23.9 percentage point outperformance during a massive bear market is a remarkable statistical achievement.
The defensive-cyclical spread caught the underlying macroeconomic rotation perfectly. It identified the flight to safety before the broader market acknowledged the danger, proving the raw alpha is undeniably present in that single axis.
The 2022 victory is empirically true, but heavily anchoring to that single year obscures the devastating operational reality of running that V1 model over a sustained, multi-year period. V1 had a fatal flaw that simply cannot be ignored: debilitating operational instability.
Catching the bear market is what matters most to capital preservation, though.
Catching it is commendable, but let us look closely at the cost of that hypersensitivity. The data shows it generated 70 regime flips in 108 months. We have to conceptualize what that actually means for a live portfolio.
It is frequent, certainly.
It is a complete fundamental reversal of the portfolio's core strategic posture roughly every month and a half. Imagine the execution nightmare. A model that constantly thrashes between defensive and cyclical allocations incurs enormous whipsaw friction.
The transaction costs alone would be significant.
The transaction costs, the execution slippage across billions of dollars of capital, the tax implications, the sheer operational drag makes a system with 70 flips practically untradeable in a live environment. It was highly reactive to basic market noise.
It treated every minor daily fluctuation in the defensive cyclical spread as a definitive macroeconomic mandate from the heavens.
Exactly. Being directionally right on the ultimate outcome of 2022 is completely useless if the algorithmic vehicle shakes itself to pieces, bleeding out through trading fees and execution lag before ever reaching the destination.
The fact that V1 captured the 2022 rotation with such precision proves that the core hypothesis is structurally sound, using the defensive cyclical spread to identify institutional capital flight to safety works.
It works in theory, but the friction makes it fail in practice.
V1 did not fail because the underlying economic signal was wrong. It failed because it entirely lacked the mathematical suspension system required to handle the granular day-to-day bumps of the financial markets. Because V1 possessed the raw signal but lacked that stability, the core architectural shift in the transition to V2 was expanding from a single axis to a three-layer composite.
Moving from relying solely on a hypersensitive isolated spread to stacking leading, coincident, and confirming indicators.
This is the essence of true multi-horizon signal separation. Leading indicators, like manufacturing new orders or building permits, give us the fastest glimpse of the future, but they are notoriously erratic. Coincident indicators, like current industrial production, tell us where we are today.
And confirming indicators, like corporate earnings or employment duration, are incredibly slow but provide absolute certainty.
By requiring a consensus across these different economic speeds, demanding that the erratic leading indicators align with the broader, slower-moving confirming indicators before executing a trade, the model naturally filters out fleeting market noise. It demands structural proof from the broader economy before initiating a regime shift.
Stacking different indicators sounds inherently robust. It appeals to our desire for confirmation. But the moment you introduce multiple layers into a quantitative allocation algorithm, you exponentially increase the dimensionality of the model.
The dimensionality is necessary to capture the nuance of the business cycle.
You are taking leading indicators which are highly volatile and prone to massive revisions, and attempting to artificially align them with lagging or confirming indicators, which are heavily autocorrelated and slow to react. When you perform this complex alignment over a strictly limited 108-month look-back window, you are inevitably finding spurious correlations.
I disagree that it is spurious. The sequence of the business cycle is a documented economic phenomenon.
We must remember that the macroeconomic environment of the 2010s, which comprises the vast bulk of this 108-month sample, was a highly specific, historically abnormal regime. It was uniquely defined by aggressive, relentless central bank intervention, zero interest rate policies, and artificially suppressed volatility.
Even in an abnormal regime, the order of operations for the economy remains relatively consistent.
By stacking 3 layers of data to navigate this highly specific 9-year period, we have to ask a fundamental statistical question. Are these 3 layers actually independent variables capturing genuinely distinct economic phenomena, or are they just highly correlated proxies being used in tandem to mathematically smooth out a backtest? A model with higher dimensionality always looks vastly more stable in sample.
The dimensionality you are critiquing is strictly constrained by the hard economic logic of the inputs themselves. We are not feeding the model random, disjointed alternative data streams just to see what correlates. We are firmly anchoring the architecture to the established, chronological sequence of the business cycle.
But the inputs are only one part of the problem.
The indicators themselves are only half the equation, yes. The mathematical rules governing exactly how the model reacts to those underlying indicators form the true battleground of this evolution. Let us examine the specific mechanics that physically reduce the turnover by 33%.
The hysteresis bands and the sigmoid blending.
First, the introduction of hysteresis bands. Think of hysteresis like the thermostat in your home. If you set your thermostat to 70 degrees, it does not turn the air conditioning on at 70.1 degrees and immediately turn it off at 69.9 degrees.
If it did, the machinery would violently shake itself to pieces, turning on and off every single second.
That is exactly what V1 did. V2 utilizes hysteresis, meaning if the baseline is 0, a signal must push significantly past the boundary, say to a +2, to trigger a regime change, and it must drop significantly below a different threshold, say to a -2, to revert.
So it requires a structural shift in the market temperature, not just a passing draft.
Second, V2 utilizes sigmoid blending. It entirely replaces V1's abrupt, binary, 100% strategy switches with a smooth, continuous S-curve allocation. Instead of dumping all cyclical assets at once, it scales capital proportionally as the conviction of the signal increases.
These are not arbitrary optimizations in your view, then?
They are elegant engineering solutions borrowed directly from physical control theory. They physically prevent the algorithmic mechanism from overreacting to marginal data shifts.
Those elegant engineering solutions are the exact textbook mechanisms of historical overfitting. Hysteresis bands and sigmoid functions are not magical stability generators that inherently understand the economy. They are purely mathematical parameters.
They are mathematical representations of economic friction.
They are tuning knobs. You describe a hysteresis band that requires a signal to reach a specific amplitude before triggering a portfolio rotation. Who precisely defined that amplitude?
The historical behavior of the economic data defines the amplitude.
The optimization algorithm defined it. It defined that amplitude by looking backward at the specific, known drawdowns of the 108-month dataset and determining precisely how wide the band needed to be to ignore the specific false positives of that exact era.
The logic of a thermostat requires setting a reasonable band based on past experience.
The same absolute logic applies to the sigmoid blending. The specific mathematical slope of that S-curve dictates exactly how aggressively the model scales in or out of an allocation. Setting the exact width of a hysteresis band and the exact slope of a sigmoid function on a known historical dataset practically guarantees you can mathematically engineer away any historical drawdown.
We are not just engineering away drawdowns. We are applying robust control theory.
The ultimate vulnerability is this. If we change the look-back period, if we run this exact model with these exact hysteresis bands through the protracted stagflation of the 1970s or the massive volatility expansion of the dot-com bubble burst, Does the sigmoid curve still hold? Or does the entire allocation system completely collapse because its parameters were perfectly tuned to the artificial, low-volatility gravity of the 2010s?
Theoretical debates over parameter robustness and the dangers of curve fitting are entirely valid, but they are ultimately resolved by examining the model's actual behavior during unprecedented out-of-sample volatility shocks.
You are referring to the 2020 pandemic crash.
To answer your question about how it handles environments outside its training data, we must look at the definitive 2020 proof moment. How does a model built on 108 months of normal central bank cushioned economic cycles handle an overnight total global economic shutdown?
The pandemic crash of early 2020 was an event with absolutely no historical precedent in the training data.
If the hysteresis bands and sigmoid curves were merely overfit to the mild, localized corrections of the 2010s, the model should have failed catastrophically when faced with a true exogenous shock. Instead, we saw a decisive, unarguable separation in performance.
Let us hear the specific numbers on that separation.
V2 returned a positive 19.5% in the year 2020. V1 managed only a positive 4.8%. Let that gap sink in. That is a 14.7 percentage point outperformance in a single year, achieved during a violent macroeconomic environment the model had never seen before.
The 2020 outperformance is undeniably impressive. Surviving a real, live stress period of that immense magnitude does give the V2 model a genuine baseline of credibility.
It proved empirically that the mathematical mechanics of the algorithm did not simply break or divide by zero when market volatility violently expanded beyond all historical norms.
It proved survival, yes.
The mechanics did not just survive, they functioned exactly as designed under maximum systemic stress. Let us walk through exactly what happened in those crucial weeks. When the initial terrifying shock of February-March 2020 hit the markets, V1 violently chopped itself to pieces.
Because it lacked the suspension system, it aggressively dumped risk assets at the absolute final bottom of the crash.
And then it triggered immediate, desperate buy signals days later after the Federal Reserve announced emergency interventions, constantly whipsawing and locking in massive losses as the daily data fluctuated wildly.
V2 behaved fundamentally differently.
The hysteresis bands prevented the immediate liquidation.
They physically prevented the model from immediately liquidating its equity positions at the very first sign of statistical panic. It required sustained structural deterioration before executing the sell-off. But more importantly, as the rapid V-shaped recovery materialized in the spring, the sigmoid blending allowed V2 to scale back into risk assets smoothly and continuously.
It scaled in without binary commitment. It captured the massive upside of the equity recovery without committing entirely until the slow-moving confirming indicators officially ratified the signals flashing from the leading indicators. The 14.7 percentage point gap between V2 and V1 is not an anomaly. It is the quantifiable mathematical dividend of applying control theory to sheer human panic.
I will readily concede that the precise execution of the sigmoid scaling during the rapid 2020 recovery completely validates the mechanics of the S-curve when operating in a perfectly V-shaped market. However, we must strongly caution against validating a decade-long algorithmic framework based on a single, highly anomalous calendar year.
2020 was the ultimate stress test, anomalous or not.
The 2020 crash and subsequent recovery was a pure liquidity event. It was a massive market cycle artificially compressed into a few short months by unprecedented multi-trillion-dollar fiscal and monetary policy. The sigmoid blending worked perfectly in that environment precisely because the broader market recovered in a perfectly smooth, continuous, relentless upward trajectory engineered directly by the Federal Reserve.
The model still had to correctly interpret the data of that recovery.
It looked like a flawless mathematical curve because the market was acting like a flawless mathematical curve. We must ask what happens in a different reality. If the post-COVID recovery had been a protracted, agonizing W-shaped grind lasting over 3 years, those specific hysteresis bands might have locked the portfolio into a highly suboptimal defensive allocation for quarters at a time.
That is a hypothetical scenario that ignores the robustness of the leading indicators.
It would have been bleeding performance while waiting for confirming indicators that took years to materialize. The 2020 success definitively proves the model handles short, sharp, immediate liquidity shocks exceptionally well. It does not definitively prove the parameters are immune to overfitting across prolonged grinding structural shifts that lack immediate central bank rescues.
To thoroughly address the persistent concern that V2 is simply an over-optimized curve-fitted entity built for V-shaped recoveries, we must look at how the developers drew the boundary of complexity. In the world of quantitative development, if adding a layer of mathematical complexity improved the model from V1 to V2 so dramatically, the logical, almost irresistible assumption is to add even more complexity to extract further alpha.
This brings us to the crucial, illuminating failure of the V3 iteration.
And why that specific failure serves as the strongest possible endorsement of V2's structural integrity. V3 was developed to push the multi-horizon architecture even further. It attempted to utilize the concept of information entropy to actually predict regime shifts before they happen, rather than merely measuring them as they occur.
Information entropy attempts to mathematically quantify the level of disorder and unpredictability in the market system.
It tries to front-run the actual economic data by identifying when the system is becoming too chaotic to sustain its current trend.
The result of this highly complex experiment was an honest negative result. V3 underperformed V2 by a margin of negative 0.2 percentage points.
The developers accepted the underperformance. The failure of the entropy experiment fundamentally proves that the development of V2 is not just an infinite, careless curve-fitting exercise. There is a hard mathematical boundary between regime description, which V2 absolutely masters, and regime prediction, which V3 attempted and failed to achieve. V2 found the exact optimal limit of what the economic data can actually support.
The negative result of the V3 entropy experiment is highly significant. In fact, it is the absolute strongest piece of evidence that the V2 architecture is actually grounded in economic reality rather than being a pure optimization illusion.
It shows restraint in the development process.
In a poorly designed, overfitted development paradigm, adding a highly complex mathematical layer, like information entropy, almost always artificially improves the historical backtest. It does this because it provides the algorithm with an entirely new, vast dimension of parameters to manipulate and perfectly align with past events.
The quantitative developers could not force V3 to outperform V2 and rigorously accepted the negative 0.2 percentage point underperformance rather than tweaking the entropy parameters until it worked.
This indicates a highly disciplined, scientifically rigorous testing environment. When they attempted to squeeze more predictive juice out of the historical data using the chaos metrics of entropy, the market actively punished them. It demonstrates a profound truth. The market's true structural signals are definitively finite.
You cannot endlessly mine data for future certainty.
V2 sits exactly at the frontier of what is mathematically knowable about the current economic state. It measures what is happening right now with maximum stability without crossing the dangerous line into forecasting illusions.
The synthesis of these points leaves us with a profound realization about quantitative system design and market behavior. The combination of the 2020 stress test, which definitively validated the control theory mechanics under extreme out-of-sample pressure, and the V3 entropy failure, which clearly established the absolute boundary of useful complexity, fundamentally shifts the narrative of this transition.
The 108-month calibration window absolutely means V2 must be monitored closely going forward. We cannot afford to ignore the fact that the specific sigmoid slopes and hysteresis parameters were derived from a highly specific historical epoch.
However, the core architecture itself, the multi-horizon signal separation, is mathematically and economically sound. It does not rely on a single fragile data point.
It relies on the deliberate, logical synthesis of leading, coincident, and confirming data.
And it is structured meticulously to resist the inherent noise and panic of financial markets. V2 did not win by predicting the economy perfectly. It won by becoming harder to fool.
This is the research desk officially signing off.